and welcome to this video on Business and Entrepreneurship Education Grade 9. In this video, you will learn about Unit 13, which is on income statement. The first lesson for this unit is about the different parts of an income statement. Now, let's look at the learning objectives for this unit. At the end of this unit, you will be able to outline the different parts of an income statement and identify items in a trading account. Do you know what an income statement is? Well, the income statement is a classification of income and expenses from which profits and losses are calculated at the end of the accounting year. First, let's look at the difference between income and expenses. What is income? Income is money that a person or a business receives in exchange of providing a good or service or through investing capital. It is used to pay day-to-day expenses of the business. What are expenses? Business expenses are the costs of running a business on a day-to-day basis. Some examples of business expenses are rent, wages, electricity bill, water bill, and so on. Do you know what an accounting year is? Well, an accounting year is any period of 12 months, that is, 1 year, for which records are kept and profit is calculated. The accounting year can be shown on a timeline. The timeline consists of 12 months. An example of a timeline is shown on the screen. It starts on 1st June 2018 and ends on 31st May 2019. Let's now move on to the format of an income statement. The income statement is divided into two parts, namely, number 1, trading account, and number 2, profit and loss account. Trading account. The trading account records items which deal with the trading activities of an enterprise. Trading activities refer to the buying and selling of goods. The aim of the trading account. The aim of the trading account is to find out whether an enterprise is making gross profit or gross loss. Items in trading account. The trading account consists of revenue, opening inventory, cost of sales, closing inventory, purchases, and these are used to calculate the gross profit or gross loss of the business. Let us now consider the items in a trading account in more detail. Firstly, the trading account consists of revenue, that is, sales. The second element in a trading account is opening inventory. The opening inventory is the amount of stock that an enterprise has on hand at the start of an accounting period. The third element in the trading account is purchases. Purchase means to buy something. The fourth element in a trading account is closing inventory. It is the amount of stock that a business still has on hand at the end of an accounting period. The fifth element is cost of sales. Cost of sales refers to the amount spent to obtain the goods that have been sold during the accounting year. Did you know? Cost of sales is also known as cost of goods sold. Finally, the above elements are used to calculate the gross profit or gross loss of a business. Gross profit is the difference between revenue and cost of sales. The formula to calculate the gross profit or gross loss of a business is gross profit or gross loss is equal to revenue minus the cost of sales. Let's take an example to calculate the gross profit. If the revenue of a business is 15,000 rupees and its cost of sales amounts to 5,000 rupees, therefore the gross profit is equal to 15,000 rupees less 5,000 rupees. This gives a gross profit of 10,000 rupees. Let's now look at a second example. The following information is extracted from the books of Sami, an entrepreneur. An income statement is prepared for the year ending 31st December 2018. Here, revenue amounts to 20,000 rupees and cost of sales amounts to 6,000 rupees. So, to obtain the gross profit, we need to take revenue of 20,000 rupees minus the cost of sales of 6,000 rupees, and this will give us a gross profit of 14,000 rupees. Remember, the cost of sales figure of 6,000 rupees is put in brackets as it must be deducted from revenue. Note, if revenue is greater than cost of sales, gross profit is obtained. Similarly, if cost of sales is greater than revenue, then gross loss is obtained. The formula to calculate cost of sales is cost of sales is equal to opening inventory add purchases less closing inventory. Let's look at an example to calculate cost of sales. If the opening inventory is 4,000 rupees, purchases 1,000 rupees, and closing inventory is 2,000 rupees, therefore, to calculate the cost of sales, we need to add purchases of 1,000 rupees to the opening inventory of 4,000 rupees. This will give us 5,000 rupees. After that, closing inventory of 2,000 rupees needs to be deducted and therefore it is put into brackets. This will give a cost of sales of 3,000 rupees. Let us now take a look at inventory. There are two types of inventories. They are opening inventory and closing inventory. What is opening inventory? It is the amount of goods that enterprises usually hold at the start of the accounting period. Opening inventory is added in the calculation of cost of sales. What is closing inventory? It is the amount of goods that enterprises usually hold at the end of the accounting year. Closing inventory is deducted in the calculation of cost of sales. Moving on, let's look at an example of an income statement prepared for John, an entrepreneur selling cakes for the year ended 30th June 2020. The revenue of John's enterprise is 20,000 rupees. He purchased raw materials costing 7,000 rupees. He has an opening inventory amounting to 2,000 rupees and a closing inventory of 4,000 rupees. So, when drawing the income statement, it is important to write the entrepreneur's name at the top so as to know for whom the income statement is being prepared for. Then, at the top of the table, you should write the income statement for the year ended following by the date, and here the income statement is prepared for the year ended 30th June 2020. As seen on the screen, the income statement consists of 3 columns, and the 2 last columns are smaller as they contain the amounts paid and received. Now, filling in the income statement, first we have to record revenue of 20,000 rupees. Revenue is written in the first column and the amount is entered in the second column. Next, less cost of sales. To calculate cost of sales, we need to add purchases of 7,000 rupees to the opening inventory of 2,000 rupees. This will give us a total of 9,000 rupees. Then, we need to subtract the closing inventory of 4,000 rupees. Remember, the closing inventory figure is put into brackets as it needs to be deducted. These elements are written in the first column and the amounts in the second column. The cost of sales amounts to 5,000 rupees and is recorded in the third column. Again, remember to put the cost of sales figure into brackets as it should be deducted from revenue to calculate the gross profit. So, gross profit will be 20,000 rupees revenue less cost of sales of 5,000 rupees, meaning that the gross profit is 15,000 rupees. Here are some additional links that you may use to gain more understanding on the topic. Well, students, we've now reached the end of today's lesson. Don't forget to watch the second video, which will be on the last part of the income statement, the profit and loss account. That's all for now. Until next time, goodbye.